Something unusual is happening with a few stocks trading under $1, and almost nobody is paying attention. Smart money might already be positioning, and the window could be closing fast. These are ultra-low-priced companies operating in high-growth sectors, where small catalysts can create big percentage moves. They're not household names. They're early stage, often overlooked, and sitting in areas where industry momentum is quietly building. Now here's the thing. When stocks trade under $1, volatility increases, risk increases, but so does potential upside, especially when volume starts to spike and accumulation patterns form. The question isn't just can they move, it's will you spot them before the crowd does. Alright, let's start with the first company. This one trades under $1, tiny market cap, low mainstream attention, but here's what makes it interesting. It operates in a sector that's quietly gaining traction, a space where government funding, private investment, and innovation are accelerating at the same time. When multiple capital streams converge like that, small companies can experience explosive percentage moves. Now, let's slow down for a second. Just because a stock is cheap doesn't mean it's undervalued. Many penny stocks struggle with dilution, weak revenue, or inconsistent execution. That's the risk side, and you need to respect it. But here's what caught attention recently. Unusual trading volume. Spikes above average. That often signals accumulation. Not hype. Not social media noise. Real positioning. If momentum continues, and a catalyst hits, contract news, earnings, surprise, regulatory update, sub-$1 stocks can move 30%, 50%, even more in short bursts. That doesn't mean it will. It means the setup is forming. The name? Not yet. Patience. Now let's move to the second stock under $1. This one is different. While the first company is in an emerging growth space, this one operates in a sector that's already proven, but undergoing transformation. Think restructuring. Think cost optimization. Think strategic pivot. Here's why that matters. When a beaten-down company starts improving fundamentals, reducing debt, tightening operations, or expanding into higher margin segments, the market often reacts before headlines hit mainstream media. Recently, this company reported improving financial metrics, not explosive growth, and in penny stocks, stabilization can be the turning point. Now, let's talk risk. Turnaround plays are tricky. Management execution is everything. If leadership fails to deliver, dilution or reverse splits become real possibilities. That's why position sizing matters. Never go all-in on sub-$1 stocks. But here's the interesting part. Options activity and insider transactions have quietly picked up. That doesn't guarantee anything, but it suggests a tension behind the scenes. If momentum builds alongside improving fundamentals, the percentage moves can surprise people who dismissed it at 70 cents. Now we get to the third stock under $1, and this one is the most speculative of the three. Why? Because it's tied to a high-volatility industry, the kind of space that moves fast when sentiment flips, the kind where headlines alone can trigger double-digit percentage swings in a single session. Recently, this company secured a development milestone. Not massive revenue yet, not profitability, but progress. And in early-stage companies, progress is fuel. Here's what makes it intriguing. The float is relatively small. That means when buying pressure increases, price can move quickly. Supply and demand becomes aggressive, but remember that works both ways. Small float also means sharp pullbacks. Now let's talk reality. High-volatility industries attract traders, not long-term investors. So expect spikes, expect pullback, expect emotional swings. That's the game at this level. But if sector momentum continues building and retail attention returns, sub-$1 stocks in hot industries can experience rapid re-pricing. No company names revealed, because this isn't about hype. It's about understanding setups. Which one fits your strategy best? Accumulation, turnaround, or high volatility momentum? Alright, now it's time. Let's connect the dots. The first stock, the accumulation play under $1, is Camber Energy. Yes, that, Camber, a microcap energy company that has experienced extreme volatility in the past. But recently, volume patterns have started shifting again. Energy as a sector has been sensitive to global supply headlines, policy shifts, and commodity price swings. Here's the opportunity angle. When oil prices fluctuate, small-cap energy names can react disproportionately. If momentum returns to the sector, low-priced energy stocks often attract speculative capital quickly. Now, the risk. This is not a stable blue chip. It has a history of volatility, dilution concerns, and sharp pullback. Balance sheet strength matters. Cash flow matters. And energy prices are unpredictable. This is not a guarantee. It's a setup. Under $1 stocks move fast, up and down. If energy sentiment improves and buying pressure increases, percentage moves can be aggressive. But if commodity prices weaken, downside can be just as sharp. Position sizing, risk management, no emotional trading. Now let's complete the picture. The second stock, the turnaround play under $1, is Tunner One World Holdings, a microcap, consumer-focused company that has gone through restructuring phases. This is the type of stock where execution is everything. If management stabilizes operations and improves revenue consistency, sentiment can shift quickly. But if they fail, dilution, risk, and stagnation become real threats. Now, the third, the high-volatility momentum play, is Medical Technologies, a speculative medical technology company operating in a space driven by regulatory milestones and clinical progress. When development updates hit, these stocks can spike aggressively. But biotextile volatility cuts both ways. Delays or funding gaps can pressure price just as fast. Here's the big picture. All three trade under $1. All three carry elevated risk. None are guaranteed winners. These are tactical plays, not retirement stocks. If you decide to trade them, focus on catalysts, volume confirmation, and strict risk management. Never invest money you can't afford to lose. In penny stocks. Comment below which one you're watching. Subscribe for updates. And remember, opportunity always comes with responsibility.